Good evening to all of you. Welcome you to today's webinar. Today we are discussing the weekly option strategy. We are going to make a review of what we said last week and also give you a new strategy for this week, that is for the 22nd July expiry. Now this we have been highlighting week after week in the last couple of weeks, mainly to drive home the point that this is a very good winnable trade as well as gives a very high return on investment. And we have already explained to you that what this strategy is. This is nothing but a put spread. It is a put spread. It is a credit put spread. Okay. Now, what we are doing is, the reason generally we is that now if you feel the market is going to go up, then what are the alternatives? One is that you have to buy futures, you buy call. Okay. Third, you do a call spread, or you do a sell put, or you do a sell put spread. So these are there are some more options maybe, but I'm not revealing all. So some of these alternatives are there. We have not listed the butterflies and ratio spreads and all. It's buy futures, buy call spread, buy sell put spread. These are various alternatives as far as the opinion on the market going up. But if you apply a filter, what are the filters that you apply here? The filters that you will apply are, I want a lot of winnable trades. Winnable trades, and winnable trades should be in the ratio of 85 to 90% times. That is, if you do 10 weeks, 8 weeks should be profitable. Second thing is, I should have a good return on investment. I should have a good return on investment. Third is it must be ease of working. Okay, putting trades. Then fourth is the margin money or the capital, whatever you call it, margin money capital requirement. So these are the filters. Now, and also fifth is limited. The risk mitigation. Risk mitigation. So if you look at that, in this case, if you do a plain call, then chances of winnable trades generally will come down. It will come down to 55, 45. 55 times you will win and 45 times you will lose if you do a weekly trade. So winnable trades by call is eliminated because also the premium, so it's not very profitable. Buy futures, it is profitable, but it will get down, it will get stuck in the winnable trades percentage as well as in the margin money capital required formation. So the alternative that is left out are the call spreads or the sell put spreads. So both are almost the same depending on which strike how you place the strikes. So return on investment, risk mitigation, ease of working, margin money capital, winnable trades. Considering all these things, is that put spread is what we sell put spread. Sell put spread. Now, of course, you can also say is the same strike you can also call as buy call spread. So it doesn't matter which way you call it. Okay. Now, when you say the sell put spread, in order to not to confuse you with this. Okay. Now, where do you then choose the strike? Okay. So strike choice. Now today, as we speak, we don't have any daily options. So only on Wednesday we have options on Thursday. So what we have are weekly options and monthly option. Right? Weekly option and monthly option. Now we will go weekly option. We have got only Nifty, Bank Nifty. So for that moment, we will concentrate on weekly option. We'll strike down monthly option. Because weekly option, every week you collect premium, the summation of that possibly could be more than the monthly option. I'm just saying possible because there are certain circumstances when the monthly option can score. So generally speaking, the weekly option for a period of time when you collect the premium can work out to be more than a monthly option. So weekly option, you do Bank Nifty and Bank Nifty. So now what are the strike choices? Why should we choose a particular strike? Now you know that yesterday the market was close to 15,920. Yesterday's close was approximately 15,920. Today also it's almost like that. So Thursday, let's come Thursday. So now you are, when I said ease of working, you would like to put one trade in a week, and then probably by next Thursday you would like to close, or somewhere if you have a deep profits you would like to close, and then probably initiate the trade again next week. So that's probably is maybe your thinking. So now let's say the market is at 15,920. Yesterday it was at 15,920. Now at that time the nearest strikes which we had was 15,900, right? So or 15,950. These are the two strikes. 15,900 and 15,950 were the two strikes closer to 15,920. So we choose, let us say we selected 15,900, found out what is the call price, what is the put price of 15,900 yesterday when spot was close to 15,920. Now this call and put, when we look at this call and put and average it out, then the price came closer to 95 rupees yesterday. That is the call and the put. Maybe the call was slightly more and the put was slightly less. So the average of the call and put of 15,900 was 95 rupees. So we said that normally if you go for double this option premium, that is, if you take this 95, you multiply that into 2. So 95 into 2, 190, right? So normally the spot minus double the option price, normally we'll have a chance to be bet only 15% or even not even 15%. We have seen most of the time it's only 10%. On the downside, we get a chance of only a 10% downside possibility below twice the option premium from the spot price. That means 15,920, right, minus 190. So approximately we will keep it as 200. So it comes to 15,720. 15,720 or 15,000 exactly if you put 15,730. So now it is in between there. So you can choose either, now we have to sell. So the expectation is that below 15,720 or 15,730, the chance that the market can fall could be 15%. But as per the statistics that we have seen, which we have worked out, the chances over a period of time is only 10% of this coming below this. Okay. So when you do this, then 15,920 this particular rate, then you choose to sell at 15,720 or 15,730, but that strike is not there. So you have to choose 15,700 or 15,750. So the strike probably not to get a slightly higher premium because of the market doing well. Let us say we sell a 15,750 call. Now if we choose to sell only a 15,750 call, sorry, 15,750 put. If we choose only to sell the 15,750 put, we need to pay higher margin. Okay. Second, probably for some reason the market slides fast and sometimes a crisis can hit. Then in that case we will be at great loss. So in order to overcome that issue, we are going for a spread. And when you say the spread, there must be another leg, right? So there must be a buy leg right now for risk mitigation, to reduce the margin, and third, to have a very comfortable way of working. So we go for a buy put also at some lower strike. Buy put at lower strike. Now this buy put, since this we multiply 2 times of the option premium, this we will keep it as 4 times the option premium. So 4 times 95 into 4 was 390 rupees. So 15,920 minus 390. Okay, this was 15,530 or so, right? 15,530. So like how we choose 15,750 there, okay, there we will choose 15,550 for the buy side. So the buy side option will be 15,550 put. So now we have a spread strategy where we are selling this 15,750 put and we are buying this 15,550 put. So this is the strategy. So let's now be clear. So yesterday it was a sell 15,750 put and buy was a 15,550 put. And what was the premium that we gathered yesterday for this strategy? Was approximately net premium that we gathered was around 23 rupees or 25, whatever it is, somewhere in between this. So this was assuming this is 23 then into 50, so we're getting 1,150 rupees as the premium received. Now what is the margin for this? Okay, now the margin requirement for this is span margin, exposure margin will be there, which will be approximately 15,000 rupees approximately. Then span margin normally will be the difference between the risk 200 rupees. So 200 into 50 is 10,000, and since we have received 1,150, they will deduct that. So approximately something like 8,800 rupees or so it will come. So the trade will have 23,800 rupees margin approximately. So let's approximate it to 25,000. Now suppose if this trade is going to be profitable this week, like last week, then 1,150 is your profit, 25,000 rupees is your investment. So in this particular week, you are getting something like 4% plus, assuming that 150 rupees goes in terms of brokerage or cost or whatever it is. So you're getting something like a 4% plus. So this is the type of strategy. So for a particular week itself, you have a chance of very great profit. So now why we are saying this is we have compared this last week profit also. So last week, what was the profit? Last week the market was closer to 15,720 or so. So we did put the trade of 15,500 to 15,300 if I remember correct, and we got the same 23 rupees profit, 23 rupees approximately, and the same 1,150 rupees was retained, right? 1,150 rupees was retained. So the same trade we have now put, only thing the strikes are on the upper side because this week close was 200 rupees more. If we remember last week, I will go back to the chart. Now, last week we explained to you that the last week when we spoke, it was 9th, right? Today is 16th, it was 9th. On 9th, we said the trade was 15,689. 15,689. So that time we said that the good chance of the market probably looking towards some sort of a rally. The reason we said is, see, this particular day, we said we had 15,879, right? So 15,879 on this was the day on 7th. So when we are calculating for 15th expiry for 8 days, we found that the market should not fall by more than 240, 250 points from this place. 15,879 minus 250. So 15,879 minus 250 is approximately 15,629, right? Minus 250 rupees. It was based on that. It was 15,629 or 15,630. So for the expiry, so we said that the chances of it falling below 15,630 is not there, and we said in that case you should go for a buy. Either you can go for a sell 15,600 put, or if you want a greater profit, you should now look towards buying the futures and protecting that with something. So with some call or put, whatever it is. Now, if you look at it, the market closed this particular week at 15,920. So 15,007. So you had a 200 rupees profit. You had a 200 rupees profit. And even if you had given something in the for option premium of the 40-50 rupees also, you would have still got something like 150 rupees or so. 150 rupees is what probably you would have got. Now, the same thing if at some stage when we look at it, whether the market to what extent it can rally. Okay. Now, this particular week, because now it closed very well at 15,920, so that means it is already in a rally mode. When it is already in a rally mode, the chances of that rallying further by the option price is going to be limited. So 15,924 plus approximately the same 200 rupees, 16,120. So we don't expect the market to be much above the 16,100 or 16,120 by the end of Thursday or so. So in case if you get a faster rally by Monday itself or Tuesday around 16,100, for the next 1 or 2 days, the chances that it can slip down is very high. Chances that it can slip down is very high. So we need to work out that particular thing. So now what do we expect? Now the market expect that we are not going to get much above the 16,120 levels, above the 16,120 levels. Now if we keep it even on a 2-week basis, so let's look at the probably a 2-week basis. So this is the week last week, and this is this particular week, the week before, and so these are down weeks. So we should look at the upper side from the upside week. So this is going to be the third week, and the market was 15,860 3 weeks back. So based on the outlook, probably 200 into we will not. I'm not going to much details beyond that. So 15,820 plus some 300, 16,150, 16,160. I think it will not go beyond that. So I think if you get very closer to that particular level within 1 or 2 days, it's a good chance of going for a short. Market can reverse itself to some extent from that level. Now, going by the same logic, we have see this particular low. Actually, this is an important. This was a slightly down week compared to the previous week. So from here we should be in a position to protect from the downside. But I think now the downside is not of great interest. The only downside that we can speak from now is that what we saw last week, 15,689. And from there, if you look at it on the 200 points, then it should be this particular week, the ending week should have been 15,489 or so. So that does not happen. So it is on the upside. So this week it has closed on a bright note, which is 15,923. So from 15,923, generally speaking, I think 200 points on the lower side, 15,720, 730 should not be breached. But for Thursday, because we are not speaking about Friday, so we are speaking about Thursday. So for Thursday, what is the option premium as it stands today? Now, if you look at it, see 15,900, the average now is 15,950. It is very close between 15,900 and 950. It does not matter which one we are going to take the average premium. Here we are taking 95, here we are taking 61. So 155 divided by 278. So we will keep something like 178 to 80 rupees now on an average. So 80 into 2 is 160 rupees. Now 15,920 right now it's going at 15,920 30 levels minus 160. So we are expecting that probably it will be above 15,750 by Thursday. By next Thursday, we should not see the positions going above 15,750. So 15,750 will be if there is a sudden dip or below 15,750 or so. I think it is definitely a worthwhile proposition to look towards buying there. So the general thing is that since the market is quite bullish, so on the bullish side, definitely if the trend is good, then we should not definitely expect much below twice the option premium in a general case. Since the market is on the upside, so there is a chance that probably it can go above the option premium that we have twice the option premium. That is when we are talking about 16,150 or 160. That sometimes there is a greater possibility of that being crossed. But since it has already run up to that 16,150, 16,000, the close being such a bright close this week, from there to rally by another 200 points or so for the next week close will look a little remote. So if there is a faster rally in 1 or 2 days towards the 16,000 and odd rates, definitely it is a question to go for a sell. So we should look at such important places where we should go for a buy. And last week we got that chance. Last week this particular day gave a chance. So this particular day gave a very good chance for us to look towards buying from this particular level, right? From looking from that particular level, it was a great chance to look for a buy proposition. So in fact, similarly, if you see so many other places also, I think from there you can find out what has been an oversold or overbought, because normally in technical indicator they use the Bollinger Band and linear regression to know for the oversold and also RSI to know which has been oversold or overbought. But now we will look at it only through the option premium to know when the market, to what extent the market will close below which it will percentage chance where it will not. So for that we will do some risk mitigation. Now this was a very clear case where we could have gone for a buy, because we know that next couple of days there will be a good rally, and that materialized. So we should use these type of opportunities in Nifty and Bank Nifty. Now in the case of Nifty, now we have projected that basically we don't expect the market to be much above 16,150 in the coming week or much below 15,750. So any opportunity 1 or 2 days time, if it gives, then it should be a good opportunity for us to go for a buy. And we should also make some projections from other places also. Maybe now we are talking about this particular place. So what is the maximum that this particular place can give? Okay, based on some of this one. What is the best it can, because these are all upward points. From upward points, the rally will not cross beyond certain levels on the upside. So we should be looking at all these possibilities of the upside and the downside thing, and then from there we should make a projection of the levels, and if it comes very closer to that very fast, then we should be looking towards more for a buying there. So this is as far as Nifty is concerned. And also we look at the Bank Nifty, and also for an indication we can put a chart also. Now I mean like so this is the trend line right now. So this trend line and all, if you look at it, the next 1 or 2, 3 days, it's not falling much more, 15,710, 713. Now let's look at this. If we keep it around this level, then I think this is, if you look at it, it's all coming closer to the 16,000 and odd. So all these things, next couple of days, it's coming closer to 16,000. So going above 16,150, 60 also is not a very feasible thing. And I would say that even if you look at let us say this particular day, from this particular day, if you look at it, already the rally is a little more, because this was on 9th, right? So this is 7th, 16th. So for 1 week, normally it should be something like I told you around 200 points. So 15,689 plus 200 should be 15,889. It's a slightly oversold thing. That is above 15,889 for the day, for this week. So above 15,000, just close to 15,923. So even if you had sold and received some premium, that wouldn't have been a loss. So when it is like this itself, I think probably you can make a projection from here, which is the 13th. So on 20th, you don't expect more than 16,000 or so. So all these things will give an indication of both for intraday sell as for some positional trade for some sort of a mean reversion type of trade that you can take. So for which you need to put it for 1 week, 2 weeks, this one, so that you wait for some fall or thing to happen. Now, since this is a bullish market, I think we should look towards more slightly like this, or 1 or 2 days, slightly a rapid fall of 1 or 2 days. It should just get sold off quite fast, so that you will know that probably the fall should not be much, and so you can easily pick it up. So any faster fall of under 200 points will be a very great level to look towards on the buy side. So this is as far as Nifty is concerned, and you can look at this even in other shares and other this also. Now, for example, let's look at Bank Nifty before we for this week. How this one last week also we will look at what happened as far as Bank Nifty is concerned. Last week also we said very clearly the chances of that going above 36,000 it doesn't look great, because this was on 9th, right? 35,071. So the average option premium that was going was something like 300 rupees, 325 rupees or so. So we said into 625 or so. That this particular day, it was on 8th, right? So based on this level, so based on 8th level, which is 35,274. That day we said the chances of that going by 300 into 600 rupees, 650. We said so 35,274 plus 650 was 35,900 or 35,900, 36,000. So we said on the upside it could be approximately at 36,000 levels, or 35,850 to 900 levels. So yesterday the close was 35,907. So it did not go much above that. Okay, much above that. And today, of course, the close was 35,751, and because this was 35,721, and so 325 into 2 was approximately 650 levels. 650 to so 35,071 plus 650 itself was something like 35,720. 35,720. So let's say this was 35,751. So it went up a little high and fell, right? So when it went up to 35,985, probably we know that there is a chance that probably it can fall. So from there, since now we know that there is a chance of a fall coming because it has to correct itself by under 200 points, we should then put in some intraday filter to go for some sort of sell. Okay. So this is Bank Nifty last week. So now if we look at this particular week, the same thing, let us say 35,750, 35,900, and let's look at today's this one for the weekly expiry. What is Bank Nifty telling us from the option premium is concerned? Now it's around 35,000. So this is giving a price which is around approximately 35,800 figures it's giving. So if you look at the premium, the market volatility seems to have come down a little more. So it's looking at 255, approximately 260 points from today till expiry of next week. That is on today's again. So by Thursday, probably the chance that it could be maybe 260, 520, 500 to 600 points from here, either on the upside or downside, which means on the downside it could be 35,200, possibility at 35,751 minus 600 520 points, it comes to 35,200. So on the upside it should be 36,200, 300 levels. So let's look at this particular situation where a 35,200 put is going at 79 rupees. 79 rupees, and so the same 500 rupees we will have it on the downside. This is 33 rupees. So 79 minus 33, we will get 45 rupees there, right? So the case of Bank Nifty, so 35,200 and 34,700. So this is approximately 70 9 or sorry, I think let me see. Um, 79 minus 33. So you get 47 rupees. Upside we don't need to do because I think the market is generally on the bullish side, and so we'll do as 47 rupees. So here also the exposure margin, because it is 25 scripts, same thing, approximately into 25, 8,93,000 into 2%. So we may have something like exposure margin will be something like 18,000. Span margin will be 12,500 minus this one, so approximately 10,000 rupees. So same thing, you will get 28,000. So there also the risk for the trade was 200 rupees into 50, 10,000 rupees. 10,000 rupees was the risk there also. And here also it is 500 into 25. It is a 12,500 points risk. But you are getting slightly higher premium, I think probably 47 into 25. So you are getting same thing. I think the premium received is the same, 1,175. There also approximately is the same, right? So you're getting a premium which is approximately the same, 1,175. So the difference is not much, right? So 1,175 is what the net premium that you're getting. So the return on investment probably for Nifty is slightly even better. So 1,175. So approximately the return on investment is going to be the same approximately. So it does not matter whether you're going to do Nifty or Bank Nifty. But in case if you choose to do this, then I think probably you can do this. So last week also it was quite profitable to do that. It was quite profitable to do that. And the upside also, if you want, you can still do that. That is, I think, if you still believe that the market on the upside, it is going to be 36,200 to 36,700. This is the type of trade that you should take. But I think it is better not to do on the upside, considering the market is still on the upside, right? So the market is still, the momentum is on the upside. So we refrain from doing this particular trade, which is the sell. So unless the market starts to come down, I think it is better not to do this. So we have to look at now anything for the same amount of money. Okay, we have to scan and see whether other things are more profitable. But we don't have a weekly option in other cases. We may have only a monthly option in some other cases, which we have to look at how to work it out. That is, how do we do that particular option and probably get some benefit out of that. So right now we will look at something like this week is 16. So I think we have got 2 weeks, next week, the week after, for expiry of other option. So let's look at some other scripts. Probably let's look at maybe a Reliance Industries, just for understanding purposes. Let's look at the Reliance Industries now. Now let's look at first the chart of Reliance Industries. So Reliance, I think on a daily basis, so this seems to be forming a bottom. I think I would say it's forming a bottom, and today was a very classic case when we could have gone long above the this particular high, which is 2,095. So on a daily basis, I think so we would have been just exactly at the bottom to buy, because otherwise the 2,065 is the bottom. So 2,095 has given a good range breakout, I would say, to look towards on the buy side. So 2000 this particular trade, if we do, I think probably there's a chance that it could still climb to some new heights, and probably it can even go right up to this particular level, which is 2,175 or 2,179. So now what we are planning probably is 2,100 levels of whatever it is, 2,112. So let's look at the option price for Reliance. To what extent it can, according to the scripts, it can go. Now 2100 is the nearest strike. So 47 plus 29, it's 47 plus 29, 76 divided by 2 is 38. So 38 into 76. So we'll keep it as 40 into 2, 80. So the chances that it could be 80 rupees plus 80 rupees from here, or plus minus 80 rupees from here. That's what the option price indicates. So plus 80 rupees, if you look at it, we are minus 80 if you look at it. Let us say 2112, we'll keep it as 2100 minus 80, 2020. So but 2020 is going to give us only some 6 rupees or so. Not much of an option premium we are going to get of this. So I think the volatility has fallen so significantly that there is no point in just doing a 2020 level for just 6 rupees or 7 rupees, that too for 2 weeks, right? So that's one thing that we are getting now. Similarly, 2100 right now, and 2180 slightly on the upside it's showing. So 2180 is around 18 rupees. 18 rupees is where it is, and definitely the chances that it is going to go much above 2250 or 2060 doesn't exist. So what we can think about this is very highly unlikely, but if it comes, let's make profit. That is, you buy 2180 call. There are two options. One is you buy a 2180 call for 18 rupees, and you also do a 2260, okay, which is 8 rupees, 8 rupees, not 5. So it comes to 16 or 17, approximately the same thing. And 2340 is 4 rupees. So for 4 rupees, you get a chance from 2180 to 2320. I think probably it's a good trade, but because if you are lucky and it moves very fast, you get a good chance of making a very, very deep profit. Very, very deep profit is completely possible in this. Is possible in this. And let's say if you're not getting 2000, let's look at this figure of 2120 where it is right now. So 2120, and let's place it at 2180, because chances that it can be 2190 to 2200 going up. So what we can look at it is, this is going to be 38, 2120, and we can place 2038, and probably we are looking at 2180 to sell. So 18 into 2 is 36. So this is approximately 2 rupees only. And in order not to get ourselves on the half thing, 2240 is around 9 rupees. So you may have to spend something like 10 to 11 rupees. But chances that it may be very, very profitable to do that. 10 to 11 rupees is what probably you can look towards. And chances that it's going to be profitable is very high, because the entire position looks to be that on the upside, Reliance is likely to get on the upside, but Reliance is also unlikely, as per the option premium, to exceed 2180 to 2200 by month end. Okay, but in the case of stocks, nothing can be said. So what we are doing is that we are we are buying a 2120 call and selling 2 times of 2200 call, 2200 call. So that 2180 call, sorry, 2180 call, which itself comes to 36 rupees, right? So 38, 36, so approximately 1 or 2 rupees. You can do that calculation. 2040, so 11 rupees or 12 rupees is probably what this butterfly trade will work very well as far as Reliance is concerned. Because if you don't want to take the 2240, the problem will come as far as the margin money is concerned. So in order to obviate the margin money issue, we are putting this trade. And definitely, you will have the exposure. I think we are getting something like for this, I think 500 shares. I don't know how many shares now make up this. I think probably it's going to be it's 250 shares, right? I think it has been reduced to 250. I think so. So 250 is what it is. So 250 into this particular number. If you do that, then you have a 5 lakhs on that 3.5. So you will have 15,000, then maybe 60, maybe for 45-50,000 rupees you can do the trade and look at what profit that you're going to get out of this. Okay, so there's a very highly profitable trade is possible in this case. So suggestion is that you can definitely look towards this particular trade of 2120, 2180 and 2240. 1:2:1 you can look at Reliance. So based on this type of thinking, where you don't need to lock in huge amount of money, profit is going to be less, but chances, the winning chances are going to be very high. So now what we are doing is the same butterfly trade in Reliance. We are doing it along with the trend. Because if it has started to pick up right now. But at the same time, for it to get much above the 2200 levels, it's also not that easy, considering the option premium does not look towards facilitating a much higher value for this. So if you look at now we are talking about this is 2 weeks time, right? So under 4 weeks time, the same 80 rupees would have translated itself to 160 or 180 rupees. So now let's look at the Reliance share. So this, if you look at this particular week, okay, this is 2225, and this is the 4th week, right? So after this 1, 2, 3, 4 week. So we said about the 4th week should not have more than 160 rupees or so. Okay. So the 2225 minus that will come to 2050-60 levels, and that's where we got good support. That's where, if you see, we got good support, and for it to start moving up. So these are all good ways of looking at how the oversold, overbought conditions are being managed. Now, particularly for big scripts like good and big scripts, generally the fall will be a little bit limited. So you know that on the put side, probably sell put side, spread put side will be useful. Or on the upside, if you don't want to spend too much on the option premium, you can look at some butterfly type of strategy and see how much of return that you get for the margin money that you are going to put there. So this is how normally you can look towards trading using option premium itself. And we have illustrated what is the weekly strategy that we are going to take for Nifty. We have also illustrated what strategy we are taking for Bank Nifty. The return on investment for both of them are going to be the same. Now you can look at what probably can hold on for Reliance. Now same thing, we will see the same Nifty itself. Since if it is going to be only the movement is going to be 200 rupees maximum from here, so upside levels is not going to be more than 200 rupees. You can just look at, say, 15,920 it was. So we can look at 15,900, 16,050, 16,200. I mean, like type of butterfly. If it is going to 1:2:1, if it is going to cost very less, then you can look at that particular trade also. So let's look at Nifty. So 15,900, right now we said about 16,050. 16,050 is going at say 28 rupees right now, which means 16th we have to take from now. If you look at it, 15,950 plus the option premium itself comes only to 16,020 or 30 levels. So I think that's the level where probably you'll have 1:2 will coming at this one. But nevertheless, 15,950, 16,050 and 16,150. If you look at it, I think you will pay some 20 rupees or so right now. But not much of a width you get for making profit here. So I think it is better to go for a sell put spread itself. See, unlike Reliance gave a good amount of chance for a 10-11 rupees profit. I mean, like you have got a good amount of 60-70 rupees upside possibility was there. So though here also it looks like it for a 20 rupees and 100 rupees possibility exists, but nevertheless I think it will be a little more stifling and choking. We will not get that much of a profit fast also. So better to do the sell put spread itself strategy. So generally you can look at the strategies from the point of view of option premia, know to what extent the range is possible. Once you know the range, likely range, if the market rallies very fast to that particular place or falls below that range, then you can look at buy or sell depending on how fast certain things have come. And then you can frame your strategy like sell put spread, or probably you can look at butterfly. These type of strategies you can look for. Now 7:45. So we have a session on Monday in Tamil where probably we are going to explain again whether the requirement how to get a result which is similar to futures trade, but put far lower money. Okay, so money management and how to pick the trade, both we are going to illustrate on Monday. Please join us. Similar type of webinar on the put trade, we will have it in Tamil next week. So please join us for that. Thank you very much. Now questions please. Now margin issue, that is why we are having these classes, because margin now has to be collected as per the SEBI mandate. Every nobody can give any additional exposures. So whatever that margin that has to be laid down by SEBI, that has to be collected. So that's no alternative. So for that only we are explaining to you that you don't need to go for such type of trades where you have to pay the full margin, but you can get a result which is similar to what you want by going for much lower capital. That is what we have been explaining in the last few sessions. See, at the money put and call value, IV will not have much of a difference. Okay, but if you look at the slightly out of the money put, out of the money put will have more IV than out of the money call. Out of the money put will have more IV than out of the money. That is very characteristic of Nifty alone. It does not happen with all type of asset classes. It is very characteristic of Nifty. Now that explains mainly because one is a greater chance of the this one, that is the Nifty. Normally it's a 55-45. I explained to you 55 times. 55% of the time the Nifty climbs and 45% of the time the Nifty falls on a week-to-week basis or on a month-to-month basis, also approximately the same. So in order to compensate for that, in order to level that off, so the out of the money options are being given a higher price. So if you are a buyer of this particular option, and if you are a buyer of a call option, so because you have got a higher winning chance in call, higher winning chance as far as the market going up, not in terms of price going up minus option premium, but in terms of market going up, the IV is always priced higher. One. Second thing is that for the put, and second thing is that normally the fear factor is always more. So there's always a chance that market can, you'll always, even if the market is in a bull run, you will always think that there's a chance that probably the fall will be there. So normally the options are also priced a little expensive. And third thing is that the sellers are more as far as put option is concerned, mainly because it is almost equivalent to expressing your attitude towards buying the market. Okay, so the sellers normally will have an upper band, so they demand more amount of premium. So these things, various factors of this explain as to why the put option premium on the downside is more than the call option premium. What margin can you explain? What margin is shown in our webinar is what is the margin as far as spread is concerned. You can illustrate to us, because the spread margin, the exposure margin is nothing but 2% of the contract value. It's nothing but more than 2. You can look at other independent sites also. So whatever the value of the contract, 2% of that will be the 2% will be the margin. Now I'll explain. Now you can go to any site for that matter. Now See, if you are doing a spread strat or this one, exposure margin in the case of Nifty is 2% of the contract value. So what is the contract value? So this is going to be the same. So the contract value today is 15,900 into 50, right? So, sorry, 15,900 into 50, 7,95,000, 2% of that comes to 15,900. This is the exposure margin. There can be no doubt about this. If you're doing a spread contract, what is the maximum risk in our strategy that we highlighted? It is 200 rupees, right? So 200 into 50. Okay, this will be the span margin. Okay, so 10,000. Okay, 25,900. What is the amount of premium that you have collected? Let us say 1,000 rupees approximately. It will be 24,900. So this will be the total margin that will be required for doing this trade. You can just check. You can just check, and next class you highlight to me. If I am wrong, I will correct it. For this particular type of trade, that is 15,700 put you sell, okay, and 15,500 put you buy. You look at the exposure margin. This will be the exposure margin. The span margin which I gave will be approximately this. Okay, so you please check. This is the margin that's required. Now, as far as the futures is concerned, it will come approximately to 1.1 lakhs. Okay, as far as the total span and exposure margin is concerned, I think the futures trade today may be approximately 1.1 lakhs. I am not very sure about the exact amount, but it's approximately 1.1 lakhs. Thank you very much. So please come back on Monday. Thank you very much.